So there was a new SPAC that was announced recently, made headlines, popular here on YouTube, and I want to take the opportunity in this video to talk more about this business, look at its fundamentals, and figure out if this is actually an investable opportunity. So far in 2020, we've seen a ton of SPACs. In fact, 2020 has been what some would call the year of SPACs, with a record 141 companies that have entered the public markets so far through a SPAC this year. Over $50 billion in value has been brought to these businesses as retail investors, hedge funds, and the other big boys on Wall Street pile into these hot new public stocks. And it's no secret, I've been pretty critical about these SPACs, most of them actually, here on the channel. Not afraid to voice my opinion on those, and not afraid to say when I smell something funky with these companies. And guys, let's be real, if IPO stands for it's probably overpriced, SPAC most likely stands for stupidly priced acquisition companies. In most cases, what happens, these SPACs, they build up hype before the ticker symbol changes, they go skyrocket, people make a lot of money. However, a lot of investors are left bag holding, the stock, changes symbols, hype dies down, and reality sets in, fundamentals set in, and that's the end of that. Now, the SPAC we're discussing today is a bit different from a lot of the other hype EV ones specifically. This is not an EV stock. That's why I really wanted to spend some time to look at this company today. That's why I wanted to spend some time to understand this business, look at its competitors, look at its fundamentals, and figure out maybe this is actually a pretty good investable opportunity. So anyways, let's get this party started. Smash that like button down below if you haven't already. It helps out the channel a ton, and that's all I ask from you guys for making these videos. But either way, let's reveal the stock. Opendoor is the company that we're going to be looking at here today, and I asked you guys to hit 1,000 likes on a previous video if you wanted to see this, and you did, so here's my end of the deal. Now, Opendoor, or IPOB, IPO 2.0, whatever you want to call it, that it's currently traded on the markets right now as, is a SPAC that Chamath actually created, who is a well-known venture capitalist billionaire. IPOB is one of many SPACs in a series of companies that Chamath wants to bring to the public markets to give retail investors like us an opportunity to support these small yet innovative companies that are trying to change the world for the better. And well, clearly from the stock's performance this year, IPOB has indeed found a candidate, and that company, like I said, Opendoor, which is a real estate business. Opendoor intends to unlock home ownership for millions of Americans to help them with buying and selling a home. So far, consumers seem to be loving their service as shown here, as they've served over 80,000 customers, totaling over $10 billion in home values that have been sold. Revenue growth has been absolutely phenomenal, and when compared to their competitors, they claim to have sold 4.4 times more homes than their competitors in 2019. So real estate, no secret, it's been a very hot market, especially here in 2020, so this company should continue to do well. However, the question you gotta ask is, how long will this party keep going? How long can real estate prices keep booming? How long can all this excitement around real estate really keep going for? Those are the tough questions, because eventually prices will stabilize, and at that point, if you're invested in the company, you got to really understand what their future looks like in those situations as well. Now, Opendoor plays in a market that's extremely large but extremely fragmented. This is of course the real estate industry, and it needs disruption, and some of their competitors have been doing this in recent years. They have a strong focus on value, they provide low cost to their customers, which in turn leads to superior customer experience, which means more referrals and repeat customers, which in the end is what something any successful business has. Opendoor is also a high growth company, and as we saw previously, you are getting a company that is growth focused, which is something the market is currently looking for. And finally, they claim to have strong fundamentals and margins, which we'll take a look further into later. Now, if you look at the market they're currently in, Opendoor has the world at its fingertips. $1.6 trillion per year industry to go after. It's no surprise that Chamath believes this company has huge potential and pull in over $50 billion in revenue in due time. In fact, in this letter from Twitter, when he made the announcement about this merger, he stated that he expected 2023 revenue to be around $9.8 billion, which is a double up from last year's revenue, and I personally believe this is a very conservative estimate. Okay, now let's take a look at the valuation of Opendoor before we actually compare to its competitors to determine, is this stock actually at a good value? So here's the breakdown of ownership and valuation, and as of the announcement, Opendoor was at an enterprise valuation of $4.8 billion, billion. On top of this, they will have well over $1 billion in cash from the proceeds of this deal, giving them a lot of money to keep growth and expansion up to capture more market share. But clearly, since this merger intention announcement was released to the public, the stock has shot up. Valuation as a result has also shot up. So we need to calculate what the actual value will be when the ticker symbol does change to Opendoor. Here's a calculation that was used to initially come up with the $4.8 billion valuation. And the only thing changed here, circled in red, is the IPOB price, the original ticker symbol price. So with the new price today of around $24 per share, this puts the new value of Opendoor when it does close to around $15.1 billion. So that's quite a substantial increase. 4.8 billion to around 15 billion in just about a month. Yeah, there's a lot of hype around this company, a lot of money being flooded into this. So now let's spend some time looking at this company compared to its biggest competitors to see, even after this big run up, if there is an opportunity here. So here we can see I have Zillow, Redfin, and Opendoor listed. These are three companies that compete with each other. And looking first at 2019, because these were actual results, we can see that Opendoor is by far the cheapest from a price to sales valuation. This is despite them pulling in the most revenue compared to its peers, so this looks very undervalued from this metric. But then when we look at 2020 estimates, 2021 estimates, you'll notice that there is something going on here. Revenue is actually expected to decline, which means price to sales goes up. But even with this, it's still slightly cheaper than the other two. But from my perspective, its price to sales is now pretty much in line. So what does this mean? Well, after this big run up since the announcement, going from around $5 billion to $15 billion, a triple up in valuation, the company doesn't look as attractive anymore from a value perspective. Because it's pretty much in line now with Zillow and Redfin, I really have to ask myself, what makes Opendoor better than these two companies? What makes Opendoor a better opportunity? What do they have going for them that could definitely put them at the number one spot, keep them at the number one spot? What is their secret sauce, if you will? Honestly, looking at these businesses, I can't really tell what Opendoor brings to the market that the other two can't offer or don't already offer here today. There's not too much moat around this business. Sure, they have a brand name behind them. Sure, they bring in the most amount of revenue, but does that make it a good investment? Not so much in my books, unfortunately. The initial valuation of $5 billion, that was an attractive valuation. And if the stock was trading at that still today, it would definitely be on the top of my list for stocks to consider to buy here in October specifically. But that's not the reality of the situation. The stock has run up, hype has gotten into this, and it's pushed valuations up to where it doesn't really make sense because of the added risk. What risk? Well, this is still a work in progress. The merger isn't completed. It's expected to complete sometime soon. However, until that merger completes and the ticker symbol changes over, there's still a little bit of risk that, maybe things don't pan out, the merger fails, and the value in IPOB stock price will plunge as a result if that happens. That's the risk, and it doesn't really make me want to invest in this company because I could just go out there and invest in Redfin or Zillow, which are at similar valuations looking at 2021, but they don't carry that same risk because they're already both public companies that are traded on the markets. Now here's the outlook for Opendoor, and maybe this will help some of you who are invested in this business. While there is a short-term decline, they expect revenues will start booming once again in coming years, ultimately resulting in their contribution margin increasing drastically. But even though this looks all fine and dandy, my concern is that this is all tied to the real estate market doing well in coming years. Like I said, everything relies on how the real estate market does. If the real estate market continues doing well, which is most probably what they predicted here with these projections, then yeah, Opendoor could be a big winner. However, if things start stagnating, if we start leveling off, maybe even start declining, Opendoor is going to get affected by that along with its competitors as well. And that brings you to another risk, right? So typically when I invest in stocks, I'm exposing myself to the stock market, fluctuations, volatility, all that kind of stuff. Great, I can handle that. However, when you invest in a stock that's also a real estate play, you're exposing yourself now to two different things. The stock market could crash, yeah, that could bring your stock prices down, but the real estate market could also crash, and that could bring Opendoor stock price down. So I don't know if it's worth the added risk. I personally would probably prefer investing directly in real estate, like, buying a house, rental property, that kind of stuff. But to each their own, and I'm sure that, if you're already heavily exposed to real estate, you want some exposure to stocks stocks as well, you could make a case here that Opendoor, along with its competitors, are good plays. Now, because of all the reasons I outlined, Opendoor, not an investment for me, at least not here today. However, valuations dropped to where they were initially, around $5 billion or so. You can bet that I'd be interested even with the added risk. I think at that point, the risk to reward makes a lot more sense. Either way, guys, let me know in the comment section down below, what do you think about Opendoor? Do you think they can beat their competition in Zillow and Redfin here? Or do you think they'll kind of just all move in tandem? Any three of these stocks should be winners over the long term. Love to hear your thoughts in the comment section down below. Either way, guys, thank you so much for watching. Don't forget to invest positively, and I'll see you in the next one. Peace.